You've been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today's video, I'm going to do a case study of how to know your investment processes and systems with 100% certainty are working. Before we get to the actual, I'm going to share my screen here with you guys. Before we get to that, I'm listening to the audiobook version of Financial Shenanigans 25th Anniversary Edition. I read the book years ago, but I wanted to read the updated version because it's one of my favorite books ever. It talks about how to spot management issues with cash flow, balance sheet, income, pushing or recognizing income in current year that you shouldn't be, pushing income to later periods to deflate earnings and show greater earnings the next period, and all sorts of financial stuff, how to fix that. So what does this have to do with today's topic? Well, I was listening, I think it was in the first quarter of the book, first 10% of the book, maybe, definitely the first quarter of the book. And he started talking about Iconics, ICON as the ticker. And I was just like, I did a case study on that company 3 years ago, almost to the day, April 16th, I think it said on my other screen, about why that at that time was the worst company I'd ever evaluated. It's now been overtaken by an even worse company, which is kind of hard to imagine. But this, again, I've been doing this for 12 plus years. I know my processes and systems work because of the results I produced in that time period or in this time period. But it's always great to see something like this as well, especially when it comes to accounting issues. Iconics was found, they had to actually restate, I think, 4 years of full financials because they were misrecognizing cash flow, I think, cash flow revenue. We got to the notes here in a second, but they had to essentially restate 4 years of financial statements, 4 full years of financial statements, because they were doing stuff they shouldn't be doing, and they actually became a case study in the Financial Shenanigans 25th Anniversary Edition book, which is pretty fascinating. So, but here, before we get to the actual notes that I took on them and what I said about them at the time, this, if you come up with great processes and systems and they're producing great results, you're doing great. If your investment processes keep you from making massive mistakes and investing in terrible companies, you're doing great. But there's always probably a little bit of doubt in there. Am I too conservative? Am I not conservative enough? But if your book, if a company you did a case study on shows up in Financial Shenanigans and you said they're one of the worst companies you've ever evaluated, again, at that writing 3 years ago is the worst company I've ever evaluated, that's probably a good sign that your processes are working. So let me share my screen here. And we'll get to the notes. Okay. So, excuse me. So here are the 2 articles I wrote in February and April of 2016 on Iconics. Found them to have the highest free cash flow margin I've ever seen, about 48.5%, I think, if my notes or memory is correct. But they had a ton of debt. So I knew I wasn't going to invest in them because they were already too risky, just based on my preliminary analysis. But I wanted to dig in further to the financial statements to figure out what was going on, because it was super weird that they're based on royalties So they shouldn't have that much debt, and they had a ton of debt. So if you want to follow along, search Icon over here. Water. Search Icon over here, and both of these articles will come up, and you'll be able to see what I'm talking about specifically. I talk briefly in here about what I found out. This is the big one. So these are my notes I took. Again, these are my personal investment notes. I take notes on every company I research. These are my personal investment notes on Icon. Again, from that time, based on December 31st, 2015, end of year, or sort of. And I'll get to sort of in a second. So it had to restate its financial reports. Again, never a good thing. This was one of the first things I came across when I was reading the financial statements. And it actually ended up being 4 full years of financial statements had to restate. Again, it's not good if a company has to restate 1 year of financial statements, let alone 4 years. Massive red flag. Again, I'm going to kind of scan through the major points here. All of this here are my notes, very important concepts about these things I talk about further above and down here as well, further above or further below. But they are very important. I highly recommend you go. That's why I showed you this. Go to the blog, search Icon, and find this. I'll also put it in, try to put these notes in the actual blog post itself so you don't have to actually search as well. Okay. Another major red flag. So the company had debt that was about a 2.5% rate, and it took out more debt to pay off this debt that was 11.5% interest rate. Absolutely insane. Companies don't do that unless they absolutely have to. You usually see the reverse happen, and I actually go through a detailed example in here of after the Great Recession, because of the interest rates going way down to historical lows, companies, even with a lot of cash like Apple, would take out debt just to pay off either more debt, higher interest rate debt, or to buy back shares or finance whatever they wanted to finance. This company did the exact opposite. They took out low interest rate debt and paid it off with very, very, very high interest rate debt. Again, you don't see interest rates this high unless the company's in trouble. This is, especially in this 2016, interest rates were still at or near all-time lows. That's absolutely insane to have an interest rate of 11.5%. Moving on. Okay, here's the entire example I go through. Okay, here's where I go through the debt and what the debt covenants say. Something I've never seen before. Not this line, but the next line. Priority lien essentially means that that first priority lien is that they will have a first chance in any kind of default, bankruptcy, whatever, to get hold of the company's assets, whatever they're collateralized by. Typically, it's by real estate, inventory, accounts receivable, whatever. In this case, again, something I've never seen, is that essentially, if a default or bankruptcy takes place, oh, here we go. The lender, the person who lent Icon the money at the 11.5% rate, they will be able to gain access to all equity of the company subsidiaries and all assets of the companies except for those explicitly stated above here, which wasn't very much. Again, I talk about how I've never seen this here before and how crazy this is. CEO resigning. Okay, and I'll go on from here, and I go on from here. Again, I'll link these to the video below, or to the blog post. There we go, and the video below. Sorry, my dog's barking for some reason right now. Make sure to read these notes. Come up with great processes, great systems to spot terrible companies fast, so you can find potentially great investments faster. You don't spend time on crap companies like Iconics unless you want to, for the purpose of learning. In this case, it was fantastic learning about this company, because essentially I go through in my notes and say, the Warren Buffett has a saying that you need to count on, essentially you need to be able to count on a monkey being able to run the business. The business should be so simple that a monkey can run it, because someday somebody will, or a monkey will be running it. Essentially an idiot will be running it. In this case, this company took a incredibly profitable business model, levered it up with a massive amount of debt and assets like mall brand, what I consider mall brand or lower brands, Ed Hardy, Rockaware, I think Danskin is one. I didn't go through my entire notes earlier, but brands that aren't huge, like Gucci, Louis Vuitton, these type of things. But not only that, they also focus on the teen market, which changes like that. Teens change their wants, likes all the time, because as teens grow, they become adults, and then more teens come up and whatever, they don't like the same stuff. So they not only have a great business model that they ruined, that produces a ton of free cash flow with highly leveraged debt, buying assets that aren't well-known brands, they also focus on an incredibly, probably the most difficult market to go into, is the teen clothing market. Then they further compounded these issues by, again, because they did these things, they had subpar returns. Then they compounded these issues by essentially fixing their financial statements. They got found out, the CEO got fired, the company got fined, they had to restate financials. So this leads to entire massive problems, this entire process. And this company, again, I say somewhere in my notes that monkeys actually would have done a better job at running this company, because they would have done nothing. This company essentially took a great business model and just completely ruined it with their decisions. But again, I just thought that was interesting. I wanted to share this because, again, you know your process. I already knew my process was going well because the results I was producing and stuff like that. But when you see the worst, again, at that time, the worst company you've ever invested in as a case study in the Financial Shenanigans book about their accounting practices, I thought that was pretty crazy to see that. Again, highly recommend these notes. I was just rereading them a little bit ago, or scanning through them a little bit ago, and talk about my previous eBay business and here in the economics of that. Economics you need to watch out for, competitive advantages, mall brands, mental models in these notes, all sorts of other stuff that is great information. And it's all free. You can download it for free either below, or again, go to the blog, Value Investing Journey blog, and in the search bar, type in Icon, and you can find it free there in the second part of the Icon case study from April 2016. Hope you found value in this. Hope you found some comedic value. Hope you stay away from these companies. Hope your processes and systems help you stay away from these kind of companies, because you will save a lot of money, a lot of headache, a lot of frustration just by staying away from these terrible companies. Again, and with my processes, I'm able to evaluate and find out these companies faster so I can discard them and then go invest in potentially, or go to research potential great companies quicker. So I hope you enjoy. Again, leave comments, questions, concerns in the comments below, and I'll get back to them. And until next time, have a great day. Talk to you soon. Bye.